In 2007, a Wall Street bank sold its clients an investment shaped in part by a man who was betting on its failure. The clients were not told. 3 years later, that bank paid $550 million in fines. And in the same year the conduct took place, it posted the most profitable year in its history. This is the story of one transaction, one synthetic financial product, and a set of decisions that a federal regulator, a Senate committee, and $500 million in penalties could not erase from the balance sheet. Or, it turns out, from the firm's profit column. When people describe the American housing market in 2006 and early 2007, they tend to reach for superlatives. Prices had been climbing for a decade. Lending standards had loosened to the point where mortgage brokers were approving loans with minimal documentation, minimal verification, and minimal concern for whether borrowers could sustain payments over time. The market had developed a logic of its own. Prices would keep rising, refinancing would always be available, and risk was somebody's. Institutions, housing had become a machine for generating fees. Banks originated mortgages, packaged them into securities, sold those securities to investors, and collected at each step. Investors, in turn, were hungry for yield. Interest rates were relatively low, competition was intense, and structured products tied to mortgage performance offered returns that looked attractive to institutional buyers around the world. Out of this environment came the collateralized debt obligation, the CDO. A CDO works by pooling a collection of assets, typically bonds or slices of mortgage-backed securities, and then dividing that pool into tranches that carry different levels of risk and return. The top tranche is supposed to absorb losses last and therefore carries the lowest yield. The bottom tranche absorbs losses first and offers higher potential returns in exchange. By the mid-2000s, the market had gone further. It had developed the synthetic CDO, a structure that did not require actual mortgage bonds. Instead, it indicates the economics of holding those bonds. Think of a credit default swap as a form of insurance. One party pays a regular premium, and if a reference asset defaults, the other party pays out. In a synthetic CDO, investors effectively sold that insurance on a portfolio of reference assets they never actually owned. This was efficient for the banks assembling these structures. You could build a synthetic CDO faster, in greater size, and with more flexibility than a traditional CDO. You did not need to source the underlying mortgages. You needed counterparties willing to take the two sides of the trade. And it meant that someone with a strong view about which mortgages were going to fail could, in theory, work with a bank to design the reference portfolio. For a firm like Goldman, synthetic CDOs were also attractive from a business standpoint. They generated substantial fees without requiring the bank to hold the underlying assets on its balance sheet for extended periods. Goldman served as the arranger and the counterparty facilitator. It could earn revenue from the transaction regardless of which direction the underlying market moved, provided it managed its own risk position correctly. The alignment of interests between the arranger and the investors buying the product was not, structurally, a built-in requirement of the model. John Paulson ran a hedge fund in New York. By 2005 and 2006, he had developed a thesis that the American housing market was fundamentally unsound. The loans being written were poor quality. The securities built on those loans were mispriced. And when prices stopped rising or credit conditions tightened, a large portion of the mortgage-backed securities market would collapse. Paulson wanted to bet against that market at scale. Credit default swaps on individual mortgage securities offered one path. But Paulson was looking for a more precise vehicle. A structure where he could have input into exactly which securities the bet was placed against, and where the terms were tailored to his fund's specific view of which parts of the market were most vulnerable. In 2006, Paulson's team approached Goldman Sachs. Goldman was one. Building the structure required a counterparty with the capability and market reach to assemble the transaction, price it, and distribute it to institutional buyers. Goldman had both. The firm's structured products group had the technical fluency to construct a reference portfolio that would meet Paulson's requirements while being presentable to the investors Goldman would need to bring in on the other side. The arrangement required both parties to find what they were looking for. Paulson needed a vehicle. Goldman needed a deal. What they proposed was a synthetic CDO in which the reference portfolio, the basket of mortgage-backed securities the structure would track, would be assembled with Paulson's input. Paulson's fund would take the short side of the trade, purchasing credit protection that would pay out if those reference assets declined or defaulted. Someone else would take the opposite side, effectively selling that protection, and standing to lose money if the reference assets performed poorly. For this to work as a marketable product, it needed a portfolio. And it needed a story. ACA was a bond insurer with experience in structured credit. In the marketing materials Goldman prepared for potential investors, ACA's involvement was presented as that of a portfolio selection agent. A neutral, experienced third party whose job was to evaluate and approve the reference securities on behalf of everyone involved. The marketing deck that Goldman distributed to potential investors referred to ACA as a portfolio selection agent, whose experience provided a form of independent oversight. Investors were getting the judgment of a disinterested professional whose interests were aligned with theirs. What those materials did not disclose, according to the Securities and Exchange Commission, was that Paulson's fund had played a significant role in identifying and influencing which specific mortgage-backed securities ended up in the reference portfolio. Paulson's team had proposed securities for inclusion, pushed back on names they did not want, and negotiated the composition of the portfolio with a clear objective: to select. The SEC later found that Goldman's offering documents contained material misstatements and omissions by failing to disclose this conflict of interest. ACA's own position in this arrangement has been the subject of considerable discussion. The SEC complaint suggests that ACA may have been operating under the misimpression that Paulson's fund intended to invest on the long side of the deal, aligning its interests with ACA's. If that is accurate, it means the party presented to investors as the from an incomplete picture of the deal's fundamental structure. The entity supposed to be protecting investors may not have known what it was protecting them from. Goldman completed the structure in early 2007. The product was designated Abacus 2007 AC1. The reference portfolio contained 90 residential mortgage-backed securities. Goldman took the Abacus deal to market. The marketing materials were distributed to institutional investors in Europe and the United States. The pitch emphasized the quality of the portfolio selection process, the credentials of ACA management, and the diversification characteristics of the reference pool. It was presented as a professionally managed structured credit product in an asset class that institutional buyers had been purchasing for years. Investors were asked to evaluate it on those terms. The terms did not include any information about who had shaped the portfolio or why that party had shaped it the way it did. The investors who purchased exposure to Abacus They were institutional investors with experienced analysts, risk management departments, and the resources to conduct their own diligence. The question the SEC's complaint raised was not whether they were sophisticated. It was whether they had been given the information they needed to make an informed decision. One major buyer was IKB Deutsche Industriebank, a German commercial lender with a substantial portfolio of structured credit products. Another party was ABN AMRO, a major Dutch bank. Both had access to the marketing materials Goldman had prepared. Both were aware they were buying into a synthetic CDO tied to mortgage-backed securities. Neither, according to the SEC, was told that the hedge fund on the other side of their trade had substantially shaped the portfolio they were exposed to. When Paulson's team sat down to select which mortgage-backed securities would go into the reference pool, they were not making neutral analytical judgments about quality. They were constructing an investment thesis, whose value. The investors who sold protection against that portfolio were exposed to precisely the risk Paulson had identified. The investors on the long side stood to gain if the housing market held. Paulson stood to gain if it collapsed. Only one of those outcomes was coming. The housing market began deteriorating in 2007. Home prices in key markets started declining. Delinquency rates on subprime mortgages began rising. Credit conditions tightened. Stress was visible in broad market data. By 2008, it had become a crisis that would reshape global finance. For Abacus 2007 AC1, the deterioration was rapid. According to public accounts of the deal, within 1 year of the structure being assembled, every single bond in the reference portfolio had been downgraded by credit rating agencies. Every one. The portfolio that had been presented to investors as professionally selected and independently managed had collapsed entirely. The investors who had sold protection on those securities absorbed the losses. IKB Deutsche Industriebank lost approximately $150 million on its exposure. The ABN AMRO position later passed to Royal Bank of Scotland, which was subsequently bailed out by the British government during the financial crisis. The losses from one transaction in New York had propagated through the European banking system. Paulson's fund collected on the protection it had purchased. According to public accounts of the trade, Paulson made approximately $1 billion in profit from Abacus 2007 AC1 and related positions. Goldman Sachs, as an institution, had a different 2007. The firm reported net income of $11.407 billion for the full year, making 2007 the most profitable year in Goldman's history to that point. Goldman's own mortgage traders had taken substantial short positions against the housing market during this period, offsetting losses elsewhere in the firm, while clients around the world were taking losses on structured position had, in broad terms, gone the other way. The gap between what the firm was selling and what the firm was doing would become central to the political and regulatory response that followed. The Securities and Exchange Commission opened its investigation into the Abacus transaction in the years following the financial crisis. The inquiry focused on a specific question: whether Goldman's failure to disclose Paulson's role in selecting the reference portfolio constituted a material omission under securities law. On April 2nd, civil complaint against Goldman Sachs and against Fabrice Tour, a Goldman vice president who had worked on the Abacus transaction. Tour had been deeply involved in structuring and marketing the product. The SEC complaint included portions of internal communications in which Tour described himself as standing in the middle of complex trades he had helped create, as markets around him began to buckle. The charges landed days before Goldman's executives were scheduled to appear before the Senate Permanent Subcommittee on Investigations, which was conducting its own inquiry into Goldman's mortgage business. That April 2010 hearing became one of the more widely watched congressional inquiries into Wall Street practices in recent memory. Senators read from Goldman internal emails concerning the firm's various mortgage-related products. The hearing explored the broader question of whether Goldman had routinely sold products it did not believe in. Goldman denied the allegations. The firm argued that it had made appropriate disclosures, that sophisticated counterparties had independent means of evaluating risk, and that its own trading positions were unrelated to any obligation to its clients. The firm noted that in many of the relevant transactions, Goldman itself had taken losses. The debate about what Goldman knew when it knew it and what it owed its clients did not resolve itself in that hearing. It moved to a negotiation with the SEC. On July 15, 2010, Goldman Sachs agreed to settle the Securities and Exchange Commission's civil charges related to Abacus 2007 AC1. The settlement amount was $550 million to the United States government and $250 million distributed to investors who had suffered losses. At the time it was announced, it was the largest penalty ever paid by a Wall Street firm in a settlement with the SEC. Goldman did not admit to wrongdoing. That is not an unusual feature of SEC settlements. But the firm's accompanying statement did acknowledge that its marketing materials for Abacus 2007 AC1 contained incomplete information. The acknowledgement stopped well short of conceding fraud. It established on the public record that what Goldman told its clients was not the whole story. The SEC described the outcome as a significant result for investors and for the integrity of the markets. Goldman's stock, which had dropped sharply when the charges were first announced in April, recovered after the settlement terms were disclosed. The fine, though large in absolute terms, was absorbed by a firm that had reported $11.4 billion in net income in 2007 and more than $8 billion in 2010. Fabrice Tour was not included in the 2010 settlement. His case proceeded through the civil courts separately. In August 2013, a federal jury found him liable on 6 of 7 counts of civil securities fraud related to the Abacus transaction. He was later ordered to pay $825,000 in penalties and disgorgement. He was the only individual who faced civil liability in connection with the Abacus deal. Goldman Sachs, as an institution, paid the fine and moved forward. What does the legal conclusions and read the public record? It establishes that Goldman assembled a financial product in which the party selecting the reference portfolio had an economic interest in that portfolio's failure. It establishes that this fact was not disclosed to the investors who took the opposing position. It establishes that those investors lost money while the undisclosed party made approximately $1 billion. And it establishes that Goldman settled for $550 million without admitting the conduct was fraudulent. What the case does not establish is intent, because the settlement did not require Goldman to admit it. Civil securities cases can resolve without a finding of intentional wrongdoing. The gap between what was disclosed and what should have been disclosed can be real and damaging without anyone being found, under the law, to have acted with the purpose of deceiving. That gap is worth sitting with. Financial markets operate on information. When one party to a transaction has access to material information that the other party does not, is ultimately a legal and factual inquiry. But the question of whether it represents an acceptable way to do business is a different question. One that courts and regulators can address, but cannot fully resolve. The Abacus settlement landed the same month as the passage of the Dodd-Frank Wall Street Reform and Consumer Protection Act, the most significant overhaul of American financial regulation since the 1930s. The legislation included provisions aimed at improving disclosure requirements, oversight of complex financial products. Whether those provisions would prevent a structure like Abacus from being assembled again was debated at the time of passage. It has been debated periodically ever since. Goldman Sachs continues to operate as one of the most profitable and influential financial institutions in the world. Abacus 2007 AC1 appears in regulatory case studies, law school curricula, and congressional testimony as one documented example of how the structure of a financial product causing another set to risk they were not fully informed about. The $550 million was paid. The standard for disclosure in structured financial products shifted, at least in its legal articulation. The question of what a financial institution owes to the clients it serves is older than any of these events and has not been settled by any of them. If you have a view on where the line should be, leave it in the comments. And the next episode takes a different angle on institutional collapse. A company that was called the most innovative in America 6 years running while committing fraud the entire time.